Now, let's turn our attention to question number 1.4. 1.4. What is the accounting rate? The requirement, what is the accounting rate of return based on the average investment? What is the accounting rate of return? Now, the clue to do this is that you must know, one, the formula for accounting rate of return, and you never go to the exam not knowing what the formula for accounting rate of return is, and especially practicing to do it so well. So accounting rate of return using the average method is the average profit after depreciation divided by the average capital invested. Average profit after depreciation divided by the average capital invested times 100. You must definitely know this formula, otherwise you cannot even attempt any question on accounting rate of return. More so, the average capital invested, let me put asterisk here, is giving us initial investment plus residual value divided by 2. You must also know this one, otherwise you are not going nowhere. So we have this. The second thing is to know that accounting rate of return uses profit, not cash flows. So where you have cash flow, you must be able to convert it from cash flow to profit. But you know that in the tuition, when you watch the video, I've given you the profit. When you add depreciation, it will give you cash or give you the cash flow. So profit plus depreciation gives you the cash flows. So even if you are giving cash flow and you want profit, then just take the cash flow and less the depreciation, then you get your profit. Now this is a particular question which gave you the cash flows. And once you have the cash flow, you need to take away the depreciation so that you can get the profit, because the formula says average profit is what you should use. Now, BPLC is considering investing in a new machine. The machine will cost $20,000. That is the initial investment. Has expected life of 5 years with a residual value of $4,000. So this is the initial investment. This is the residual value. The machine will increase the operating cash flows, not the profit, cash flows. So all the figures you have are cash flows of the company. But I know that if I have the cash, I should take away the depreciation to get my profit. So let's start. The first is total cash flows, which is 3,000 plus 4,500 plus 6,500 plus 5,200 plus 4,000. Please use your calculator and let's see what figures you get. And if my calculation is anything to go by, the total cash flow is 23,200. Use your calculator. Don't just follow by not taking calculation. Just do it. Don't just take my figures. Just take the calculator. 3,000 plus 4,500 is 7,500 plus 6,500. Then you get, I think, 14,000 and so on. 19,200, 33, 23,200. Second, because you have the cash flow, we need to less the depreciation. Total depreciation. We have total cash flow, we need total depreciation. If the initial investment is 20,000 and the residual value after 5 years is 4,000, initial minus residual value gives us the depreciable amount, not the depreciation per annum, the total depreciation. So the total cash flow of 23,200 minus total depreciation of 16,000 will give you the profit after you have taken the depreciation, or it will give you total profit. And by this total profit is after depreciation. And so this gives you 7,200. But remember, the formula is not total profit after you have taken depreciation. The formula is average profit. So now, to get the numerator, the average profit after depreciation over 5 years is 7,200 divided by 5 years. Then I'll get the average profit after depreciation. So each year it is 1440. Use your calculator to do these ones. So the numerator is 1440. Average profit after depreciation, 1440. But the average capital invested, so let me write here 1440 divided by initial plus residual, which is 20,000 plus 4,000. See that I'm using initial plus residual divided by 2 because that is what the formula says. And I don't want you to confuse it with total depreciation, because total depreciation or depreciable amount is the initial investment minus residual value. But if you want the average capital invested, it's initial plus residual divided by 2. 1440 divided by, into bracket, 20,000 plus 4,000 divided by 2. And when you have done this one with your calculator, I guess you get 12%. And 12% gives you the answer to be D.